right, everybody. I was going to dive right into it, but Greg brought up COVID, and it just gave me like PTSD on the word or the phrase supply chain. I don't know how many times I heard that, said that. So, we constantly, like Greg said, AI is a buzzword. There's always something that's there to talk about. The other thing that I was going to bring up is that I thought that I heard every Gregism out there. But this week he's shot two of them at me. The one was the fire extinguisher one. I have not heard that yet. And the other one was wearing your shoe, not mine. He said that last week, and always surprising me with something that he's got some kind of analogy for everything. So if you work with Greg, you probably know that. If you don't, I'm sorry I don't have that laundry list of things to throw at you, but I'm going to start banking some of them. So I was challenged with coming up here talking about market trends going forward, historical patterns, and I thought to myself, I don't have any idea. So I'm going to talk about a couple things, and then I'm going to bring Logan up here, who we have invested a ton of time into letting him go and run wild with his educational background. He's obtained a CFA designation, which is a Certified Fund Analyst designation, which kind of puts him at the pinnacle level of our industry for understanding the ins and outs of how a lot of this stuff works. Followed up by him in that designation was Adam. Adam's not going to come up and talk about this because you guys will just fall asleep, and it'll be ugly. So Adam's going to talk about something else, but just to give you guys an idea that we've gone in for the office and said, hey, we need guys to go in and start looking at the zeros, the ones and zeros of this market so that we can be better prepared for what it's going to throw at us. So real quick, I'm just going to talk about historical markets over April to October over since 2000. So what we're seeing is the S&P's average return and the Dow Jones here at 7.8%, 6.6% for the year. Going into April, October, those windows are somewhat half, 4.1%, 3.57%. All that I'm trying to do there is point out that there's an old adage out there that says sell in May and go away. Okay, so you just stay in the market the first half of the year, and then you get out for the rest and then jump back in. Like Greg said, market timing, not a good idea. But here in this case, it's kind of showing us that the market really does kind of run its average throughout the entire year. So if we got 4.1% from April to October, we probably got a very similar return in the other months that are not included. So the only month that really stuck out to us was September. So if you're thinking about going and spending some money or something like that, September might be the time to avoid taking money out of the accounts. But that really was the only one that had a significant average loss time over that 25-year period. So for us, again, it's about staying in the market and understanding risk levels and where you're comfortable. We can adjust along the way, but we're not looking to try and time anything. And this market's it's throwing a million things at us, and it's going to throw a million more. So with that, I think I've probably spoken to my level of expertise, and I'm going to have Logan come up here and run through some things with you that are going to be really, really exciting.
All right, everybody. So my name's Logan, if you haven't met me, and they stuck me with the boring slides, so I'm going to do my best, guys. So looking at some historical trends and trying to think, okay, how could we use that data to help us today? So we're in a midterm year, if you don't know that. So we went back and we looked at the last 10 midterm election years, going back to 1986. and then every 4 years since then, with the last complete midterm year being in the year 2022. So the averages up there are the average in midterm years. So the S&P average 2.2, the Dow average about 4%. So what that means, we could be in for, kind of a mild market this year, which isn't the worst thing. It actually gives markets some time to breathe. If we had 15% returns year after year after year, either one of two things would happen. The market would quickly go into a bubble, and then we know what happens there. Or the other option is earnings would have to grow so fast in these companies to be able to support those prices, which would cause inflation to go crazy and just make everything unaffordable. So if we do have a mild year this year, at the end of the day, it's not the worst thing. It can actually be really beneficial for markets' longevity. So I said it can average 15% every year, but the year after midterm years, the markets actually average 15 to 16% in those years. So kind of a takeaway from that is market gets a little bit uneasy with change. So regardless of who's in office, who's changing, doing whatever it is, we see in those midterm years, markets are a little bumpy. But the year after, once everything gets put into place and everything settles down, we've seen some really strong markets in those years. And then just to kind of tie everything together for you, maybe give like a reference point. Over that time frame, that 1986 to 2022, the average over that 30 plus years was about 8%. So just to kind of complete the picture of the averages there. And then being that we're in a midterm year, next...
That was the exciting part.
Yeah. Yeah, being that we're in a midterm year, this chart here, it shows Republican, Democrat, or both. So this looks at going back to the year 1900. If you invested $1,000 into the Dow, but you only invested in certain periods of time. So back in the year 1900, if hypothetically you put $1,000 in the market and you just left it in that whole time, today would have been worth over $1 million. And then those other lines on there, they break it out between, if you said, hey, I'm only going to invest when it's a Republican held government, only a Democrat held government, or you say, I don't like either of them, I need a divided government. All those returns came in at about $10,000. So it really shows just the big disparity between the two and the importance of, like Greg said, time in the market, letting markets do their things, and not being emotional, but being rational in our decision making. So I guess biggest takeaway from this chart, we all should have been born in 1900 and put money in the market. Okay, this is the fun one really. So this slide here, it says, what does a declining US dollar mean? So over the past year or so, the US dollar has been declining in value. So when they say it's declining in value, it means it's relative to a basket of other currencies. And so to start, what makes up the value of the dollar? First bullet point there, growth in the US or GDP. So that's gross domestic product. Interest rates in the US versus interest rates in all the countries around the world. And then capital flows. So whether money is going into the US economy or flowing out. So the three of these items are the biggest drivers in the value of the US dollar. And all three of them kind of work interdependently. So I have a circle up here. I'm going to go through it with you. I'm going to do my best to keep you all with me. If I get my bullet. Here we go. Up at the top. So we're starting with US growth outperforms. So that means we have really strong GDP. So I think the US economy is booming. Everything's going very well. Businesses are expanding. So when that's going on, once expansion gets too hot, inflation starts to get too high, the Fed says, you know what? You guys are having too much fun. We're going to raise interest rates. So what that does, raising interest rates, it makes it a lot harder on consumers to go borrow money to like buy a car, buy a house, take out a loan to start a business. So what they're doing there when they raise interest rates, they really want to bring inflation down. Coincidentally, by raising interest rates, that raises something called the risk-free rate of return. So our interest rates are higher in the US economy versus, broadly speaking, when we're in a rate hike cycle. So if I'm an investor in, we'll say, the United Kingdom, and my interest rate in the UK that I could get is, let's say, 2%, but in the US it's 4%, I'm going to say, why would I want a 2% return when I could go buy a US Treasury and get a 4% return? So that causes money to flow into the US. So rates higher, money flows into the US. That causes the US dollar to strengthen. So eventually, those rates that the Fed rose, it gets to a point where they say, okay, you guys have suffered enough. We're going to ease up a little bit. And at that point, and they do that because growth will underperform. So once growth underperforms, the Fed lowers interest rates really to boost the economy. Because they say things have gotten too slow and they're scared that maybe we're going to go into a recession, whatever it might be. So they're going to lower interest rates to try to boost the economy. When that happens, we see those monies that came into the U.S. flip-flop. They're going to go out, the dollar is going to weaken, and then it's just a big rotating circle. So all of that kind of leads into the next slide of when the U.S. dollar is in a declining cycle. We took a look back, going back the last 50 or so years. So those light blue lines up there, those are the periods when the U.S. dollar was declining. The dark blue shows periods where it was strengthening or appreciating. So when we take a closer look at those time periods, we see in the declining years, foreign markets had performed really strong. In the U.S. market still performed strong, but in the U.S. dollar appreciating years, we kind of see those trends flip. So like I said, over the past year, we've seen the U.S. dollar start to decline. In the last few decline cycles, average about 7 years or so. So potentially we're at the beginning of just a cycle change, and all of it's part of normal, healthy market movements. But something that we did as we kind of see things happening, recently you probably all seen some notifications come in. We made a few trades to just allocate a few more dollars internationally, try to take advantage of some different things that we're seeing on here. And like I said, just because you're in a declining cycle doesn't necessarily mean that U.S. markets are going to be bad. So took a closer look at U.S. markets specifically. So what this chart shows, Mag 7, so those are the 7 biggest companies in the U.S., probably the biggest 7 companies in the world. It's like Google, Amazon, Microsoft, Tesla. And then as you go down that chart, those are indexes that are of smaller and smaller market caps. So like I said, Mag 7, biggest companies in the world. The Russell 2000, that's a small cap index. And then it's a sliding scale in between there. And then what this chart's showing, it shows how well those companies source sales internationally. So those bigger companies, you see it says 49%. That means they have 49% foreign sales exposure. So if we're going into a period of potentially, weaker U.S. economy versus maybe what we've been in, we see, okay, how did the sales look for the companies? And we can see they should be pretty stable because they're sourcing across the globe rather than just specifically in the U.S. where small caps tend to do that more so. And the other item I talked about, currency appreciating and depreciating, that helps those companies that are having those foreign sales. But let's say Tesla sold a Tesla in UK. So it's sold in the pound, I believe. Sharon? Okay. Sold in the pound. So then what they'll do, they got to convert that back to the US dollar. So if those currencies are moving like that, it can actually boost the sales of that company. So that's another thing that I'm taking a look at.
I wanted to hit the key takeaways here, but that's not bad for somebody with a bachelor's of science in nursing. So the key takeaways are going to be sell in May, go away is not really something that we're going to follow. Midterm elections still can create solid growth for us. And change in the market, is it bad? It's not necessarily bad, but the market doesn't like change. It's no different than the news reporting. If there's fear, you're gonna make decisions. You're gonna be emotional. The market is the same way because we all are the market. We're much larger a part of what happens on Wall Street than we ever have been in the past. So when we get emotional and we make rash decisions, it's gonna don't think you're the only one. There's a lot of people doing it, and it's creating a lot of that movement. So, and then lastly, no matter what the market's doing, we're looking for opportunities to go in and find ways to make money in a bad market, or look for opportunities that set us up for the next upswing. So we're always working, and we got two of the best in the area that are looking at this stuff on a daily basis. So with that, I think we're going to move on to Mike.